Hey everyone, welcome back to Corporate Decoder. Today we're diving into a filing that marks the very beginning of a company's journey in the public markets. It seems like they're setting the stage for something big, or maybe just getting their ducks in a row for their debut. If you love getting clear, no-nonsense breakdowns of these corporate documents. Make sure you've hit that subscribe button, and hey, we've got a fantastic community over on Discord, linked down in the description, where we chat more about these filings and what they really mean. So let's decode this. Alright, what we have here is a Form 8K filing. Think of this as a company's way of telling the public about important events as they happen, kind of like a press release, but with official SEC backing this particular filing from Bluerock Acquisition Corp, or BLRQ as it is sometimes known, details the completion of their initial public offering, or IPO. This is the moment a private company officially becomes a public one, with its shares available for anyone to buy on a stock exchange. The key date here is the 10th of December 2025. That is when the main action happened. This is when Bluerock Acquisition Corp officially sold its first shares to the public. Now, what are they actually selling? We've got units, which are like a little package deal. Each unit contains one Class A ordinary share, which is just a fancy term for a regular share of stock, and 1/3 of a redeemable warrant. Warrants are like options to buy more shares later at a set price. They also registered the individual Class A ordinary shares and the warrants themselves. All of these are trading on the Nasdaq Stock Market LLC, a major exchange. Interestingly, it identifies itself as an emerging growth company. This is a designation for newer, smaller public companies that get some regulatory breathing room, like fewer reporting requirements for a while. It is a common status for companies going public. The main event described here is the company's IPO. They sold 17,250,000 units at $10 per unit. This means they brought in a massive $172,500,000. This is the money they get from selling the company's ownership stake to the public for the first time. They also mentioned they entered into several agreements to make this happen. These include things like an underwriting agreement with the banks that helped sell the shares, a warrant agreement detailing how those warrants work, and agreements with their sponsors and directors. These are all standard pieces of the IPO puzzle. This section talks about a private sale of warrants that happened at the same time as the IPO. They sold 4,500,000 special warrants called private placement warrants to the company's sponsor and the underwriters. These also cost $1 per warrant, raising another $4 million. The filing states these were sold under an exemption from registration, meaning they weren't offered to the general public but to specific, sophisticated parties. Here is some news about the leadership team. Peter Cotton and Andrew Wexler were appointed to the company's board of directors. They're noted as independent directors, which is a good sign for good governance. They've also been placed on key board committees like the Audit Committee and the Compensation Committee. Andrew Wexler will chair the Audit Committee, and Peter Cotton will chair the Compensation Committee. This signals a new phase for the company's leadership as it steps into the public spotlight. The filing also mentions that the directors received shares as compensation. Peter Cotton got 20,000 Class B ordinary shares, and Andrew Wexler received 40,000 Class B ordinary shares. These Class B shares are often used as founder or director stock. They also updated their governing documents, specifically their second amended and restated memorandum and articles of association. This is the company's foundational legal document, like its constitution. Amending it signifies changes in how the company will operate now that it is public. This section is quite important. It details what happens to all the money raised from the IPO and the private warrant sale. A huge chunk, $172,500,000 of the net proceeds, has been placed into a US-based trust account. This money is managed by a trustee Continental Stock Transfer and Trust Company. Now, this trust account is a common feature for special purpose acquisition companies or SPACs like Bluerock Acquisition Corp. The money in this account is essentially held in reserve. It can only be used for specific purposes, primarily for a business combination, that is, acquiring another company. The funds are typically not released until the company either finds a company to acquire or it fails to do so within a certain time frame, usually around 2 years, at which point the money is returned to the shareholders. They can use some interest earned to pay taxes or liquidation expenses, but the vast majority is locked away. Finally, this last part lists all the official documents attached to this report. These are the contracts and agreements that make everything happen, like the underwriting agreement, warrant agreements, and the press releases announcing the IPO. So, what is the story here? This filing is all about Bluerock Acquisition Corp, making its grand entrance into the public market. They've successfully raised a significant amount of capital through their IPO and a private placement of warrants. A large portion of this money is now sitting in a trust account, waiting to be used for a future acquisition. This is typical for a SPAC. The company has also put new directors in place and updated its internal rules. Looking at this from a strategic perspective, it's clear what Bluerock Acquisition Corp is set up to do: find and merge with another company. The $172.5 million in the trust account is their war chest. The clock is ticking though, as SPACs typically have a limited time frame to find a suitable target. The success of this venture will hinge entirely on their ability to identify a good acquisition target that can create value for shareholders. The appointment of independent directors is a positive step, suggesting a commitment to good governance as they move forward. The risks here are pretty straightforward. A failure to find a suitable acquisition within the allotted time will likely lead to the dissolution of the company and the return of funds to shareholders. So that is the primary challenge they face. Alright, that is our breakdown of Bluerock Acquisition Corp's IPO filing. What is your take on this SPAC strategy and its future prospects? Do you think they'll find a great company to acquire, or will the clock run out? Drop your thoughts in the comments below if you found this analysis valuable. Please give this video a like and subscribe for more deep dives into corporate filings. And don't forget to join the conversation over on our Discord. The link is in the description. Thanks for watching, and we'll see you in the next decode.